The stock of Zee Entertainment Enterprises is currently in a free fall. Since the announcement of the termination of the $10 billion merger with Sony, the company's fortunes have plummeted. Zee has reported flat performance in the past 4 years, as revenue growth has converged flat in FY 2022-23 and EBITDA margin dipped to 10.7% in FY 24. Reason for the tapered revenue growth has been attributed to losses in the OTT and TV businesses. And now, the country's leading media conglomerate is caught at a crossroad of financial challenges and collapse of a mega merger plan. The Zee-Sony merger negotiations collapsed because the two entities could not agree on who would lead the new company. And at the center of it all was Zee's MD and CEO, Puneet Goenka. In June 2023, market regulator SEBI barred Zee Group patriarch Subhash Chandra and Puneet Goenka from holding any key positions in any listed company amid fund diversion allegations. Later, they got a relief from the Securities Appellate Tribunal. The ban was overturned and Goenka was allowed to retain directorships in Zee Group. Grappling with financial challenges, Zee hoped that the merger would strengthen its market position. Meanwhile, Sony aimed to expand its presence in the Indian media landscape. So, can Zee survive this mounting crisis?
I think they can surely survive in the M&E industry. There is no doubt about it. But two things is that, from a growth standpoint, from a market share gain standpoint, there are going to be challenges because what this deal of Zee Sony would have brought on the table is, multiple synergies between both these entities, a lot of technological advantage because of Sony being an MNC company, and they could have, scaled up the market and, probably grown faster than the market and gain market share as well. So I think that seems to be an uphill task now because even the external dynamics are changing. Competitive intensity has it probably will go up because of RIL Disney, being in talks. So growth, is going to be quite subdued and a challenge. But yeah, survival is definitely there is something which I don't see an issue with. Secondly, even the valuations somewhere, will remain subdued because whatever valuation uptake that the stock had seen was primarily, because of the merger and primarily because of, Sony coming in and the business synergies and the potential market share gain that would have happened. So I think even the valuations will see a sharp de-rating, and we've already seen the stock is down more than 25%. And I think there's no trigger or respite for valuations also to move up. So there's a concern on internals in terms of business and valuations for Zee.
Among leading media firms by revenue, Google India and Meta took the top spots in FY23. Zee was placed 4th and Sony at 6th. Analysts believe if Sony, Zee, Disney, or any other media conglomerate has to take on the tech giants that dominate the Indian media sector, scale is critical. Following the Zee-Sony deal failure, the upcoming Reliance-Disney merger is seen as a potential winner, despite taking a valuation hit. The Reliance-Disney alliance stands to gain significant ground in the Indian TV industry with unmatched resources and rich content offerings. With nearly 32% of TV viewership, the Reliance-Disney merger is slated to monopolize the Indian media industry. Hopes were pinned on the Sony-Zee merger to keep the landscape duopolistic. But the failure has now positioned Reliance Disney as a dominant force in the Indian media scene. So how will Zee fare against a merged RIL Disney media behemoth?
So with the merger between Zee and Sony off, I think it's advantage RIL. In any case, RIL has the has the IPL rights, and that's a big advantage because the online streaming game is basically about two things. One is about live and live sports in particular, because then a large number of people congregate together to watch something, and that's advertising driven. And the other is the catalog game, where the volume of content that you have available caters to a wide variety of users. Because what the internet has done is it's unbundled content. So therefore, it's extremely difficult for someone that has been used to playing a linear TV game to adapt to online, because it's all about piecemeal content, about binge watching. And that's where Zee's also struggled, to be honest. So I think Zee is going to struggle to compete with the likes of RIL and Disney if they do merge, or even if they don't merge. And Sony's been struggling as well. So while this merger would have made sense from a linear TV perspective. I don't think it really works even from an online perspective because they don't have that much catalog content.
While both have robust film divisions and OTT platforms, Zee has a better position in broadcast business and Sony excels in the digital space. At 12 million paid subscribers, Sony Live is the fourth largest paying streaming service after Hotstar, JioCinema and Amazon Prime. After the failed merger, Zee and Sony will now struggle to get firm hold in their respective weaker segments. So can Zee find other partners to stage a revival?
Of course, it can find other partners, but it would have made more sense if it had a partner, from the M&E ecosystem. Because currently, as we speak, there are very few players in the M&E ecosystem who would actually have a very big interest in the linear TV side. And Disney already in talks with RIL, and Sony out of the question. We don't feel that there are any kind of takers for Zee as such, and we don't even foresee any kind of other global giants coming in. So they could have probably, some financial or strategic partner who could come in, but that financial or strategic partner wouldn't get the business synergies what a Sony would get. So from valuation standpoint, even if there is somebody, valuations will not, go back to where they were because of the Zee-Sony merger getting called off.
The collapse of the Zee-Sony merger marks a pivotal moment for the Indian media and entertainment sector. As Zee looks for alternative strategies and Sony reassesses its India-focused plans, the stage is set for further transformations within the industry.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.